All right, we are live. It is June 9th. This is Shane Oglow, as always, with my partner Richard Hodges from the Rogue Traders, and this is Deribit Live, second episode. I'm pretty excited about this one. It's about rolling. And, the problem is when we're rolling, I always get that song in my head that rolling, 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 keep them. But then again, if you're not from North America, you might not get that reference. But or if you've watched the Blues Brothers. Anyways,
I think everyone in the UK certainly has watched Rawhide.
Okay, good. All right, so let's see. We got roll. Right on. Let me just check what we got going on here. We're waiting for a few more people to join us before we get started. Hey, let us know where you're coming from today, where you're at. We've got a pretty international audience, and I will publish a little poll very similar to last time. We want to know where people's options knowledge is at. So I just published that poll. You should see the poll available on the right-hand side. And that's going to give us more information on what we should be delivering in the future, what types of knowledge, and how we present it, really. So this is fantastic. Let's see where we got people from. Oh, we got someone from Dubai. There, Marcus there. Lovely. Germany. Excellent. Roll until you're right. That's right, Antoine. Roll until you're right. And even if you're not right. All right, on the chat.
Singapore, hey. Wow.
Sticky message up here. Let's see, it's 3 minutes after. We'll just give it another minute or so. More people are joining as we're talking, so that's great. As always, if you haven't signed up for a Deribit account, you can save 10% on those fees. Use our little link up above. Save 10%. All right, Croatia, right on. Italy, Poland. St. Tropez. I've never been there. That's one of my bucket list destinations, I got to admit. Have you ever been there, Richard?
I have, actually. I was deeply disappointed. I was expecting to find a cute little fishing village containing a French film star, but it was actually full of American tourists.
Okay, fine. Melbourne, excellent. Okay, good stuff. Let's make sure I got all my stuff here. I'll put up the slide while we're sitting here on the side waiting. I think we'll probably get going here pretty quick. Got a few more people coming on, but that's fine. And of course, there will be a recording, so you can catch this stuff. So today we're talking about rolling options, and we're going to make this relatively straightforward. And rolling options is something that every option seller is going to do. And you don't necessarily have to sell options too. I mean, futures traders do it all the time. If you want to be long, oil futures or something, and you buy a futures contract, well, when that contract comes to expire, if you want to stay long, you roll that forward, right? You buy the old contract back, you buy a new one, and you continue long. So rolling is nothing all that exclusive to options, but we are going to talk about it more on the short side versus the long side. You can roll long options too. So let me go ahead, and everybody can see my screen, right? I just want to make sure I'm sharing the slide, the Deribit Live slide.
I can see it.
Okay, there we go. Great. All right, so let me just go back here so I can see my presentation. And here's the plan today. This is going to be the same plan every week. We're going to do a current market analysis. We're just going to look at where the market is, or in our case now, where it isn't, right? Review current trades and strategies. As we mentioned last week, we didn't have any strategies on. No trades on. I did put a small trade on last week in terms of a strategy. Then we're going to get into whatever the topic is of the day. Today it's rolling and some different terminology. For anyone who doesn't know what rolling is, fine, we'll explain it. We're going to get into some alternate rolling strategies. So we're going to look at what people typically do, or what they typically think about doing with rolling. We'll give it some alternate strategies, some more background information, some more tools and ideas. We're going to look in the Deribit platform. We're going to look at some interesting tools in there. We're going to look at some options chains. And we're going to talk about when and why. Well, okay, here's the strategy. Here's the theory. Well, that's wonderful. When do I do it? How do I do it? Like, what's going on? What's the mechanics, and why would I want to do this, and when would I do it? We'll give you our insight on what we do when we do it. And there's, as we mentioned last time, there's There's 1,000 ways to trade the market. So we're going to show you how we do it. And then we'll get into a Q&A session. We expect today will be a lot shorter. We always want to keep things probably 45 minutes and under. So we want to leave at least 10 or 15 minutes at the end for Q&A. So without further ado, let's move on. So actually, you know what I'm going to do right now? I'm actually going to share. This is a screenshot of my silly chart. I'm actually going to share my screen so I can write on there. And do you guys see my silly chart? Yeah, Richard, you see it?
Yep.
Okay, cool. And I call it a silly chart because there's not much happening on there. Usually you look at some technical analysis chart and they've got Fibonacci's, and it looks like someone took a handful of spaghetti and threw it on there. And this is their technical analysis. And there's nothing wrong with that. There's a certain type of trading that's great. But when I teach people to trade options, simple, man. Simple is the best way to start. We're just looking for general areas where we expect things to happen. And that's what we go doing here. So I created this chart way, way back here in what is that? April-ish, May-ish, like way, way, way back. And nothing's happened. Nothing's happened. We can see this continued trend line down here. It's held this sort of bottom. Yes, it broke through a little bit, but it's kind of clung onto that bottom. We've got nothing major going on. We're just sort of sitting, waiting for the market to drop. Now, I will say this. Coming up next week, we have PMI and we have FOMC, start of the FOMC meetings. And a lot of people are...
James, yeah, it was saying, you see that little drop just to the left of your circle? The drop in
this here?
Yeah. So that was the Gensler in the SEC coming out against Coinbase and what are they called?
Yep.
The other guys, beginning of B, Binance. There we are.
Binance, yep.
So that was, I think we probably all expected that to get a whole lot worse. And Bitcoin markets just seem to shrug off the news that it's now illegal to trade Bitcoin in America.
Yeah.
So yeah, it's this stubborn clinging to this horizontal line is quite remarkable.
Yeah, and the interesting thing is we've been saying for ages that we felt a little more inclined that we would see things move to the downside, and we were preparing for that. I mean, and we've always maintained we're both prepared to be wrong every single time. And a lot of people might make the case that, hey, if this thing's sticking to the bottom, it's either going to bust through hard, or you know what, we're going back up to the top of the range and maybe through. I don't know. Either could be correct. I don't like to make predictions, but I do like to be prepared one way or another. So let me just clean these up. Now, what have I been doing? Well, I've been doing a couple of things now for a long time, and just so we know, just so we're very, very clear. This red line here, these are the meetings next week, which some people are expecting some market movement, and they could be right. So we're either going to go back at the top of the range, or we're going to bust through. I think if we're going to bust out of this range, next week is as good a time as any. So what have I been doing in the meantime? Well, ever since, I'm going to put the S of the selling back when I started doing this, I've just been selling these low delta, so these minus 10 to minus 15 delta calls, and I've been buying low delta puts, which end up being sort of 2,400 to 23, 2,200, depending on when the price was at that time, buying those puts. So these puts were free because I was selling these calls. Calls are easier to manage. If things would have rocketed up, I just would have managed those calls. And I was selling them short term. So in the month of May, for example, I was selling weeklies in May and up to the end of May into early June. And all those have expired, every single one, in the money. Expired, kept all the premium. All the low delta puts, of course, expired worthlessly because we didn't go down either. So I was just sitting there waiting because we know this trend is going to break at some point or another. So we'll see. I think that next week when we have our Deribit live, it's the first time I'm really anticipating we're going to see this or we're going to see that. I think if there's any week that, in the past few weeks where I expected something to change, it'd probably be this coming week. Now, I did make one trade. I mentioned that, and it was in ETH. And look at this. I put spaghetti all over the place here. I told everybody not to do spaghetti, and I made spaghetti. What did I do? Well, I did a small calendar spread. That's it. I put this on, we can see back in May, and I sold Ethereum, and I decided to put this in price and not delta. I sold the 2,100 June calls. We can see this red line shows the expiry here. This is the June 30th. And I bought this green line, the July 28th, 2,300 calls, 2,300 calls. This is a calendar spread. So this short calls will expire prior to the long calls. Now, why did I do this? Well, I wanted to earn a little bit of premium. I figured these things are probably going to stay in the range, but if it didn't, I'm protected. So this is basically like a vertical. But here's the thing. If this thing expires, if I let it go to expire, and I may not, I might choose to roll it. And we can talk about this later, actually, because Richard's going to have some specific thoughts on it. Let's say I roll it, near the end of July. That's fine. It depends on where the price of ETH is. If Ethereum comes up here, well, I'm going to want to roll this, and I'm going to roll it up, up to here, maybe up to here, maybe up to here. It depends where the price is. But the problem is if Ethereum drops, if we get a big move down, well, I'm still going to roll the darn thing, but I'm going to have to roll it to a lower strike price, and I'm not going to get a heck of a lot premium, but I've got the long call in place, so I may as well use it. I could close the long call out, but it'd practically be worthless by that time, I suspect, or worth not a lot. So that's a calendar spread. That's the only strategy that I have on right now as we're waiting for the market to move. So let me go back here and stop sharing my screen. Richard, do you want to talk about what you have going on right now, or any outlook you have on the market?
Yeah, I can have a quick a quick share of my screen. I can remember how to do it. Screen share. So there's the little dip that we mentioned last week. That caused vols to rise momentarily. It looked like it was dangerously as if vol was going to get up to sort of above 40 again. And then, of course, the market shrugged off the news that the US is at war with itself and Bitcoin, and vols dropped back down to sub 40. Positions wise, in Bitcoin, I have a whole chunk of risk reversals and calls. They're all sort of getting nicely green. The ones that aren't were probably written recently, or they're long puts, because we're just not getting the down move I'm kind of expecting. That's just been decaying away, and then ETH is a bit more chaotic. To this ETH book is one I've been abusing for the past half a year. I had way too much risk on it until this week. In fact, until today, because expiry's just gone through. So now my risk has gone from in the yellow and red. My margin use has dropped down to sort of more reasonable levels. 38 maintenance margin, by the way, if you're not dynamically hedging with futures, is probably still too high. You shouldn't really go above, in my view, 30%.
Yeah, that's what we tell people is 30% is sort of that max number, and that's keeping your powder dry, right? So, and just for some context for beginners, if you're running 30% margin and you've got some positions and the market goes against you, well, that 30% margin can get gobbled up toot sweet. So it's important to give yourself some room so you can adjust those trades.
And you can see that I've got some positions out in July, and the same on Bitcoin. I've got some July positions, I think, and a few August and September's, but very small size. So I found over the past month that being short the market beyond a month is just giving me too much bigger risk for the trouble. So anything I sell now, I'm selling short dated. I'm getting less vol for it, but at least it expires faster. I can get rid of it if it goes wrong, and it gives me far more opportunities to roll out if I need to.
Cool.
Yeah, that's all for it.
All right. So you can shop your screen, and I'll go back to the slides. So it's a very interesting time right now. We've had 2 months of not much going on. We never really anticipated this to happen. We thought every week there'd be wild, crazy action and doing all kinds of stuff, but it's been really, really quiet. And I anticipate things will change again. I mean, the crypto market, we have gone through periods of relative calm. But anyways, so Richard, What's the one thing that you do before you roll calls? This is a trick question, by the way.
One thing I do before I roll calls.
Yeah. Well, I'll tell everyone what you need to do. You need to take Rolinol. Rolinol. If you're under pressure, you just take one dose of Rolinol, and you feel much better. You'll start getting sleep at night. You won't have sweaty palms. So just so everyone knows, I'm not a graphic designer. I don't think I'm going to be hired as one, but this is the best I can do. All right, let's move on. Okay, so what is rolling a trade? Let's get into this. Rolling a trade is simply closing a position, whatever that position is, and opening another in the same underlying. So you're not going to, close a Microsoft and then open a Bitcoin, or you're talking about the same underlying asset, and it's usually the same structure. What I mean by structure is if you've got a short call or you've got a put spread, you're closing that and they're opening up a new position, the same type of position further in the future. And now this new position will have different strike prices or expiration dates. It can be done long or short options. As I mentioned at the beginning, you can roll long options if you want to, but we're typically going to focus on short options. That's usually when people are getting in trouble, or not necessarily. There can be rolls, other reason to roll short options, like locking in profits. But usually we're doing it to extend time. We're sort of buying ourselves more time when we're rolling options. Now, a little bit of terminology here. A trade can be rolled out. Out simply means further out in time. So today is June 9th. If I had an option today that was going to close and roll out, I might roll that out to June 30th or July 28th, whatever. I'm just going further out in time. That's all that means. And it can also be rolled up or down. If I'm rolling up, I'm rolling to a higher strike price. If I'm rolling down to a lower strike price. So if I'm rolling out and up, I'm rolling out to, let's say, the end of June to a higher strike price. Okay, that's all that means. That's all you really need to know for terminology. So let's take an example here. We're trading along Bitcoin, and we're pretty happy. And there's this channel. It breaks up a little bit, and we decide at this point here, where I've got the arrow, to sell a 50-day to expiration. DTE means day to expiration. So I'm selling an option that expires in 50 days. And for that, I receive $1,000. Boom, $1,000. Great, wonderful. And that strike is 27,000. So the market's around 26,000-ish. We sell the 27,000 call. Okay, this is a naked short sell, which we advise you not to do. But for simplicity, for explaining this is what I'm explaining. Got $1,000. Now, 20 days later, the market goes up. And it's near our strike price. It's farting around near our strike price. It's at the money. The option is trading at $2,000. Remember, we got $1,000 for it. Now it's at $2,000. We're $1,000 down on this darn thing, right? And we decide to roll that trade. So we got $1,000 in premium. It's costing us $2,000 to close it. So we need to find somewhere $1,000 to roll to in order to be flat. That's not to lose any money, okay? Or if we want to keep that original premium, that original $1,000, we need to find $2,000 somewhere in the market. We're going to scrounge around looking for it to make this pay off for us. So what we're doing is we're closing. You can see the X. We're closing this short call, that original position. So all we're doing is buying to close, okay? We're going to pay $2,000, and now we've got to look for that money. And we found that money. We sold a 50-day to expiration, 28,000 strike. So we closed the 27. We opened a new one at a higher price. So we rolled out and up in order to keep that 1,000 of original premium that we received. So hopefully that process makes sense. So we got in a bit of trouble. It was at the money. We rolled it out and up. We found $2,000 in order to keep the original 1,000 that we sold the premium for originally, because we're down $1,000. So I hope that was very, very simple. So interesting thing here. Let's talk about this. We can continue just over and over. If the market just keeps creeping up and creeping up and creeping up, well, we can just keep rolling up and rolling up and rolling up, right? And there's an expression, roll until you're right. Antoine mentioned it in the chat. You can roll until you're right. But rolling isn't really adjusting position, really. It's sort of a Jedi mind trick, right? What we're doing is we're just taking a loss, we're closing the first position out, we're losing money on it, and we're opening a new position to make up for that loss. But because we're taking that loss, we're actually reducing our margin a little bit each time we roll. So rolling until you're right has limitations. You can't do it forever. Now, no asset's going to go up forever. I should knock on wood, but I don't think that would happen. So it's got limitations. And if you're gobbling up a lot of margin, as Richard was talking about earlier, you might not be able to continually roll. That's why it's important to keep your powder dry.
Yeah, on that subject, when I showed my book, you'd have probably noticed that I had positions at every strike almost. And I'm very meticulous about that. I never want to concentrate risk on any one strike, because I never want to be in a position where I'm under pressure on margin and then have to roll a huge position all in one go and put my margin under even more pressure. So I'd much rather do it piecemeal, bit by bit. It means you're having to adjust the book less per day, and it also means your adjustments can be smaller.
Yeah. And the other thing I like about spreading that out, Rich, is you're right. You don't want to deal with one big problem on a certain day. You'd rather spread it out, because here's what happens. If you've got a big problem on a certain expiry day, a fear and emotion can come into play, and you're like, oh, the market's pressing against me. And you make this big adjustment, and then the market goes the other way.
Yeah.
It happens. So if you don't have all that pressure on one strike or expiry, it's going to make your life easier. So the last point here on this slide is, if your sentiment has changed, if we were selling these calls and we think, oh my gosh, you know what? We think this thing is just going to keep going up. There's news or there's technical analysis, whatever. It might be best just to take the loss instead of fighting it forever. For how long? You want to keep this rolling this for 6 months, 9 months, 12 months? You've got better use of your capital. Or you can choose another strategy that will reverse your directional risk. And that's what we're going to talk about a little bit later on. So most commonly, the strategy is going to stay the same, right? So if we're selling naked calls or covered calls or call spreads, whatever the heck we're doing, they're done programmatically. So for example, let's say you've got a system where you sell 50 days or 52 or 55 days out, and then you roll when you're about 3 weeks to expiry. Okay, great. And you just do that systematically. That's wonderful. I love systemized trading because it takes emotion out of things. So you got that naked short call option, you roll it to another naked short call. Or you got a short vertical spread, you roll it into a new short vertical spread. Fine, nothing wrong with that. But there's definitely times where we may not want to roll into the same strategy. We want to roll into a different strategy. And that's really what we're going to start talking about here. So if you remember this slide, it went up to 27,000 where our strike was. So we had to close it, right? We've got $1,000. We had to pay 2,000 to close it. Darn it, right? So we had to find $1,000 if we wanted to be flat and not lose any money, or 2,000 if we wanted to keep that original $1,000 in premium. So what did we do? Well, we rolled it up to $1,000 higher to the 28,000 strike. We sold that. We collected $2,000, and now we're going to wait. And hopefully for us, the market will just go sideways, maybe go up a bit, or maybe go back down. We can walk away and we can keep a big chunk of that 1,000, or maybe all of it if you let it go to expiry. Okay, that's the situation we were in. But what if instead of doing that same strategy, naked call to a naked call, what if we rolled that into a strangle? And a strangle, for anyone who doesn't know, is when you're selling at a higher strike price, a call, usually a call, and selling a lower price put, okay, on each side of the market price. So the market price right now is around 27,000, right? So we're selling a 29,000 strike call, and we're selling a 25,000 strike call. You'll notice now both these strikes are about $2,000 away from the current price. Now, we didn't collect 2,000 for each. We only collected 1,000 for each, but we made up our $2,000 that way. So we got that $2,000 back, and we split our risk, didn't we? Very interesting. So why would we do this? Well, we're reducing that directional risk. We're splitting between short calls and short puts. Plus, we're increasing the strike distance from spot. We're only going to potentially be wrong on one side, certainly at any one time. So we know if we're wrong on one side, if it ends up, let's say it keeps going up, okay, well, we'll only have to roll that half the original position sideways. Those short puts are going to be fine. We're going to collect all the premium for those, right? So we're reducing that. We're cutting it in half, and it's much more comfortable when you do that. Now, as we said, these are examples.
Also worth mentioning, Shane, that that'll generally have a lesser impact on your margin bill as well, because there's less directional risk here. There's
great.
Yeah,
great,
more Vega risk, but less directional risk.
Yes. I think we're going to do a call just on sort of managing margin and techniques, because I think margin is it's super important to know, and I think it's largely understood. Yeah.
It's the only subject, right, for retail.
Yeah. So we talked about, hey, we don't recommend selling naked calls, and I wouldn't recommend just selling a naked strangle either. It's got some risk, but again, these are demonstration purposes. So let's just change this right now. So because a strangle has risk, because both sides are naked, let's just add some insurance. Let's add some insurance on both sides. And when we add insurance, well, now that's technically called an iron condor. How these financial people come up with these names, I don't know, but that's what this looks like. So here we are, 27,000. We can sell at 28,000 and get $2,000, and we can buy the 29,000 and spend $1,000 in premium. So we collect 2,000, we spend 1,000 in insurance, and we get $1,000. We're protected on the upside. We do the exact same thing on the downside. We receive 2,000 in premium by selling the 26,000 puts, and we buy the 25,000 strike puts for $1,000. So each side we collect $1,000, and there's our 2,000 we need to keep that original 1,000 we made when we sold the naked call, right? But you'll notice the strikes are closer to spot. The short strike is only $1,000 away from spot because we had to pay for some insurance. If we had the naked strangle, we were selling the 29s and the 25s, right? So there's different ways you can do it. And of course, we're not going to look at this today, but we can look at going a little farther out in time. We're going to get more premium because there's more time premium built in. We won't want to get into that right now. So if the original position was a short naked option or a short vertical spread, when do we prefer to change the strategy and roll into a strangle or roll into an iron condor, which might be more common and safer because you're protected? If it blows against one side, well, you've got limited risk on either of those sides. Well, it really depends on the market conditions or if we have a particular bias. And we can also roll into a completely new directional bias, such as rolling a short call or a short call spread into a short put or a short put spread. So if I take a look here, let me share my screen again. And I go over to this Bitcoin chart. If we've got this situation where, let's say that we've sold a put spread down here, okay, and we've got this market just goes just blast through. Oh my gosh! If we think this support here that we were expecting to hold is not going to hold, there's a chance it won't. And remember, let me just draw a line here. If we think this is massive support and this thing blasts through it, well, guess what? That support now becomes resistant, and I would expect something like that to happen. Okay. So do we want to keep, rolling this down and then rolling it down and then rolling it down and fighting it? Well, maybe not. And if it did come blasting down here, we might think, hey, it's just going to poke through. Well, maybe we'll sell a call spread, Maybe we'll sell a call spread here and we'll sell a put spread down here. Now it's starting to look like spaghetti. So let me go over here. Oops. The point is we have these options available. If I think that there's big support, I've got no problem selling underneath that support, selling spreads underneath that support, thinking it's probably going to hold. And even if it doesn't hold, it will usually provides some resistance, but we can split our risk. If it comes blasting down here, hey, we can sell a put spread down here. We can sell a call spread up here, or we can completely reverse the situation and only sell a call spread. Okay, we'd have to sell that call spread a little closer to the money to make up enough premium to make up for the loss. But I'm hoping you're getting the idea.
So actually, on that slide, if you did get that big down move, then vols would probably be higher, which means that you could then get a bit more value in the put spread, certainly, that you're selling. But actually, it would also affect the call spread, even though the market skew would be to the downside.
Yes.
The at the money vols would be higher. So actually, you're still benefiting by rolling into the calls.
Yes, and I think it's important for people to understand that typically when prices drop, that's when vol is going to have the largest drops. When prices rise, certainly in the equity markets, you'll see this. That's when vols drop or get lower. And I guess the theory behind that is when things drop, it gets panicky because most of the world is long. They're long stock or whatever they happen to. They own it, and they get panicky when things drop and vols rise. When things are going up, people are like, "Hey, this is going up. I'm feeling pretty damn good," and the vols tend to go down. So that's kind of the situation with that. Let me go back to my slides. Can we see my slides? Do you see my slides?
Oh, I put a challenge out to our watchers in the chat to see if they could answer that question about why it's called an iron condor. But as no one's answered, I'll tell you. It's because of the shape of the payoff graph. It looks like a body of a bird with flat wings.
Yeah.
I've also heard an iron condor called the broker's friend. Because if you're a broker and you're charging £6 a lot for each leg, then you're going to pick up £24 a lot on that trade.
Yes.
Fees.
Broker's friend. And the butterfly, of course, looks like a butterfly because it's got a little buddy. We're not going to, let's not get into that today. All right. So the point is if we've got a short call spread, we might roll it into another short call spread. If we think that if our bias hasn't changed, if we think, hey, we're going to be fighting this thing forever, I'm more inclined to split it into an iron condor or just sell a put spread. No problem, and completely change my directional risk. So that is something that I want people to consider. The other thing that I want to talk about here is we can also deviate away from rolling out or change from rolling out to that standard expiry. So remember when I said at the beginning, people do programmatic trading where they're selling, let's say, the 55-day option, and they're buying it back with 20 or 25 days to go, about 3 weeks left to go. Or rolling that out. Fine, that's no problem. There might be times when you might want to change that pattern. You might want to sell the 40-day instead of the 50-day, or the 65-day or the 70-day. And the reason why is if it's advantageous for you to do so. And we can spot opportunities by using the Deribit service volatility tool in the platform. So let me actually go back to go over to Deribit. And you can see my Deribit screen?
Mm-hmm.
Okay, cool. Basically, when you're in the Deribit platform, if you go over to trading tools, and there's something else I want to show you too, just remind me afterwards, just to show people how to search for strikes. But if you go up here on the top panel left, is trading tools, and that's where you're going to see the volatility surface. And this is going to show you there's puts on the left and the calls on the right. And this is, you can see where the market skew is. You've got this little short-term, next day expiry spike on each side, one side or the other. And you can spot these little peaks and valleys all through time, which goes out, to March of next year. So almost a year into the future. Sometimes you will see a big, relatively high peak, for example. So we can see a bit of a peak here. That's a lot of times these are end of the month because end of the month is where most options are being traded, not so much in the weekly expiries. But sometimes you can spot some interesting opportunities. So instead of selling here, you might want to sell over here if you see this large relative difference. And that's another tool we can talk about another time, spotting relative difference on dips too. If we see something really, really cheap, we see these calls way over, way over here being super, super cheap. Let's pick some of those up. Maybe vols will rise, but we can sell against them if vols rise as well. So we can talk about that later. But the point is we can use the service volatility tool to sometimes say, hang on, before I just go ahead and programmatically sell a 50-day option, let's just take a quick peek at the volatility surface tool and see if there's any other interesting opportunities. Today, I don't really see anything extraordinary, and I wouldn't worry about it. I would just go ahead and sell it. Now, let's say we're selling options and we're going to roll. And we've got a position and we're selling, ETH, and we're going to go into the future. Today's June 9th, for example. And we're going to look at selling out and possibly up. And we need to collect $50, for example, per option. Well, all you're going to do is you're going to go to a further dated options. You're going to go into options. And here I'm going to look at June 30th, for example. And I'm going to look for $50. Well, here's 63. Here's 41. This is the 1900. And here's the 1850s. So it depends on what your strike price is. If you're at the money, let's say you're already short the 1850s. We might just want to roll it out in time and keep the same strike price. Nothing wrong with that. If we're looking for $50 here, we're going to get 62, 63 bucks here. Cool. If we decide to go up in price, we're going to get paid less. So, hey, we're not making enough. We only get 41. So we're going to need to go a little further in the future. So let's look at the Julys. Where can I pick up $50 here in the Julys? Whew. Well, 2000s, I'm almost getting there. But if I sell the 1900s, $50 higher than the current market price, I'll be making a lot more. Those are kind of not too great numbers, but this is pretty close, right? These 46s. And this is where we can say, hey, you know what? I'm not comfortable with that. I might just sell the 2100s and only get 27 and then go over here, on the put side and look for $25 over there and make it that way, right? So if I want to make $25 there, I could sell the 16s and I could sell the 2100s. And that's my long strangle. If I wanted to turn that into iron condor, I'd have to pull the strikes in a little bit closer because I need to buy insurance. But you just start to play with these numbers because you know what you're looking for. You know what you sold the option for. You know what you have to buy it back for. Now you know what price you have to go shopping for. Just going shopping. And that's what we're doing. We're just looking through these option expiries, figuring out, okay, how do we make this number up? How do we find this? Where's my bias? Where's my directional risk? Do I think this thing's going to blow through the roof? Well, I don't want to maybe sell another call spread. Maybe we'll look to split it. Maybe we'll look to sell put spreads. If you're not finding the value you want, and this is another important point, I'll get to in a second, we might have to go further out in time. Oh my gosh, you might have to go to August. We're going to pay a lot more because there's a lot more time premium in there. But there's more time in there, right? There's more time to be right. There's also more time to be wrong. And I think Richard had a good point last time, Richard, when you were talking about rolling at the money options versus once it gets in the money, right?
Yeah, if you go back to the 30th of June, 1850s, look on the call side on the
right
left.
Here.
Yep. Yeah, so you see currently they're trading at sort of 61.10, 63.88.
Yep.
But the implied vol there is around about 35%, the mid.
Yep.
Yeah, 34.9. So that implied vol is about the lowest you're going to see on that column. It's a little bit lower at 1900 oddly, but that's unusual. Yeah, it's interesting actually.
Slightly, yeah.
Yeah, it's just I think because the market's just skewed to the downside a bit. So when you're at the money, the skew has more effect than the curvature of the surface. So we mentioned in the last seminar that we did that on a relative value basis, the best time to roll is when the option's at the money because you've got the least implied vol, courtesy of being at what I call the bottom of the smile. And so you want to, if you're going to roll out, you really want to be rolling further up the smile because you want to be getting more value and you want to be giving yourself more opportunity to earn money from hedging with futures and turning spot moves into theta, which we kind of discussed last time. I probably blasted through people's expertise level, and we need to do a special course on this because it's quite important. But,
well, I think the important thing here is when we look at this low implied volatility, 34.9%, and we look at the difference between the cost of these strikes, 1850 to 1800, for example, 90 versus $60, right?
But you've got some moneyness there because the market's at 1850.
Yes, but if we look at let's say you had this 1600s, for example, for some reason, if we look at the difference between these strikes. The same distance between the strikes, but the value of these, how much it's increased, like 243 versus 149. That's almost $100 difference, right? Because that intrinsic value.
Yeah, so you definitely don't really want to be paying intrinsic value when you're rolling, for sure. Yeah. I mean, if you've been hedging with futures, it doesn't matter. You're because you'll have already made a profit to cover the loss due to increasing intrinsic. But
I think the point is don't wait to get in the money.
wait.
If you can help it, roll them at the money. You're going to do yourself a favor. It's a lot easier to roll.
It's kind of like the classic trading adage, isn't it? Which is always take losses early and get comfortable. I also wanted to mention that when you're rolling, if you've got plenty of margin left, then you can always increase the position size as you're rolling, so you can then roll to a further out strike, and that has particularly added benefits when if the vol in the later month is higher, which it currently is. If you're rolling from June to July now, you'd probably get more vol for July than June, because I think June's been pretty heavily sold. Certainly true in the first 2 weeks, the first the 16th, the 24th. So if you're rolling from there to June, you definitely get more value. And if you increase your size, it means you can go further out. If you're going further out, you're going to get more smile, therefore more vol. And so your position may look less comfortable in terms of the amount of risk that's on, but actually it might be a better value position.
Actually, Richard, I think we talked earlier about sharing some aspects of the smile. Why don't we do that? If you can show that and kind of explain graphically what you're talking about with that, because this is very important when it comes to rolling. So
I'm going to go to this rather nice screen here, options data on Deribit. You can see here the expressing volatility in terms of strike at each month. This is Bitcoin. And so the 6th of June here, you can see this smile. It's kind of more towards the puts. Actually, fairly flat around the monies. And you look into, if you're rolling from June to July, you can see that we go from this quite flat base in June around the money to quite a marked curve in the surface in July. So that seems to me to be like good rolling territory, because if I'm rolling the 20, what's the market at now? 26. If I'm rolling this 27,000 June 30 call into July, then I'm going to be rolling down to 25 and up to 28, 29. Maybe more, probably 30,000. So I'm starting to pick up some extra value. But actually, if I go out a few more strikes and sell a few more calls and puts, then I'm picking up I'm going up from 38 to 45 vols. That's like 7 vols. That's enormous.
That's a big difference.
Well, that's 1/5. It's 20% value increase.
Hey, Richard, if you remember at the beginning, I told people that I put a strategy on because we're sitting here waiting for something to happen. I put on a calendar spread. I sold some Ethereum June 30th, 2,100 strike, and I bought the July, the month of July 28th, I think is the expiry, 2,300 calls. And my plan is I'm going to either buy those June, I think about 55% ROI, so I should probably buy the June back now. But I can keep selling against those longer dated. So if we can, let's show people how we can use this data in ETH to determine maybe what's going to happen if the market goes up, the market goes down.
So what was the
2,100 was the short.
The short and the long.
June.
The longs in July. What's
July 2,300.
Okay, so you're currently paying 40 vol for your cover, and the 2,100 is trading at about 40 vol. So you've actually got very good value cover, because you're not paying any vol premium for that cover. To be honest, since you're covered, and if the market rises up to your 2,100s, you're pretty safe, I would say. Yeah. So I would actually leave that position alone and let it start to decay, because you're going to get loads of decay now from the short the 30th of June calls.
3 weeks away, yeah.
Yeah. While the July cover isn't going to decay that fast, and then you might be able to do something else with July. You could sell some more calls, even in July. Just use the same cover.
Yes, absolutely. And I think an important point is I'm very, very comfortable. If the market tanks, well, there's those options that I sold, those 2,100s, are going to expire worthlessly, or I'll buy them back for next to nothing. If the market starts to press up, let's say next week we get some news, and I hold on to these. I should be covering them anyways, because they're I've collected a lot of the premium already. and the market pushes up to 2,000, for example, or getting close to 2,100, I could buy those back, and I can sell 2,400, 2,500. Who knows? What the vol is going to be, and I've got that long 2,300 in July. So that would turn from a short spread. I originally sold a short calendar spread. It would turn it into a long vertical spread at that time, if that makes sense, because it would be a long spread because my closer strike is long, my further strike is short, but they both expire on the same time, right? They both expire at the end of July.
Looking, to be honest with you, you might have a bit of negative delta on that position. You might be able to buy a couple of futures and just let the market drift up into your 2,100 call, and then you can pick up the extra time decay, pick up the profit of the futures.
And sorry, I just finish that thought.
So yeah, sorry, and then you can, then when you buy that call back, well, actually, you've probably got profit on your cover then as well. You could even just sell the cover, you'd make money.
I want to just introduce one final little concept here. So last week we talked about hedging with futures, and we talked about how you can use futures to offset things you're not sure, or take some of the sting off some positions. We can also use a little bit of that knowledge and apply it here to rolling. So let's say you've got a position, things are starting to go not your way, and you decide to roll out. Well, you don't have to roll the whole thing. You can roll part of it. You can split it. You can reverse it. You can roll the same strategy out. But you can also buy yourself some futures to take off a bit of that thing too, even if it's just temporary, to wait and see what happens. So we can start to blend these different strategies into what, people like, oh, rolling simple. You take this position, you close it, and you sell a new one. Well, actually, we can get very nuanced with this. And it really depends on your market bias, your outlook, what's going on. I mean, there's 100 different reasons you might want to do this. So is there any advice we can give people there, Richard, when it comes to hedging off futures as part of a roll?
Well, I think, like we said last week, hedge early and hedge lightly, because you don't want to get caught out by a sudden reversal.
Yeah.
So you can under hedge with futures quite safely. You can always trade the future, back and forth as the market's going up, if you want to get more cover on. And you are always going to be achieving delta decay. So in that calendar spread, the delta of the short call is going to be decaying much faster than the delta of the long call. So your futures are going to become more effective as time passes anyway. So that's really the main thing, is having hedging 10% of your delta is better than hedging none of it, and probably better than hedging half of it.
Yeah. We don't have time to get into that. We as always, we talk too much. We go over time. So I want to get into the Q&A pretty quick, but I think the point here is, options give you options. There's a reason why options are called the Lego of the financial world, because you can construct any kind of risk reward profile. You can build them. You can use them to build any kind of a profile or payoff that you want. So don't think that you need to just have a standard. And there's nothing wrong with having a standard way, but sometimes if you're not comfortable, hey, there's options. There's other things we can do. We can completely change the risk with a roll. Why do we have to roll the same darn position up? We don't have to. We can do whatever we want. We can roll half of it and take some futures. We can. I guess I'm just trying to beat this to death by saying you have options. So, as always, or not as always, but as last time, we are offering $7 for 14 days access to Rogue Trader Academy. Again, Rogue Trader Academy, brand new. We've just got the one foundational course in there right now. More courses coming soon. Especially if you're new, it's a great place to start. But it also gives you access to our Telegram channel. So if you're more experienced, join us with the Telegram channel, and you can ask questions, and we'll post our trades in real time there. So with that said, let's talk about Q&A. Do we have any questions coming yet? I didn't set up a...
Yeah, there's a Q&A only channel here. I can see 3 questions. One from Antoine.
Okay. How do you roll long if you don't collect anything up front?
So the option that you're rolling, the long option that you're rolling, has some value, has some time value in it, or even some intrinsic value. And so what you're looking to do is roll to another say, put further out at the same price. So obviously, if you're rolling a put, you're going to roll it to a lower strike at a longer date to cost the same money. So whereas when you're rolling a short position, you're paying to close the position and then receiving premium for opening the new one. When you're rolling a long position, it's the opposite. You're selling to close, so you're receiving premium to close it, and then you're paying to open the new one. And then we've got one from G.
Yeah, are the risk reversal based on spot/vol correlation or on those directional trades?
So this was, I think, in response to seeing my my book. So yeah, I am kind of bearish on the market at the moment, so I'm happy to be short risk reversals, and I'm actually paying to be short them. I'm paying more for the puts than I'm collecting on the calls. And I'm actually also delta hedging with futures to keep the delta neutral in the book for the time being. My thinking is this: when the market does go, it's going to go fast, and it's going to go into my my puts before I can hedge them. So I'm going to pick up gamma. I'm probably going to pick up Vega as well, because vol's certainly going to spike if we get a good $2,000 or $4,000 sell-off. Then I would imagine the current baseline 35 vol is going to be more like baseline 50 vol. So those puts are going to double or triple in price, and I'm not going to care about the calls. And then I'm into a long gamma situation where I'm gamma hedging with futures until I can sell more risk. So that's just a bit of my thinking about how to trade the market at the moment. It's a difficult market to trade, right? Because there isn't much movement, there isn't much vol. It's basically going sideways. So whether you're trading spot, futures, long, short, nobody's making any money, right? You just got to position yourself for when it's going to break out.
Yeah.
And if it breaks out to the upside on a risk reversal, I'm perfectly happy to delta hedge it manually and just ride it up.
Gotcha. Yep. A question from Mia here. Maybe you can show when a calendar is too expensive in time premium versus same tenor. I guess you're referring to that ETH calendar spread I put on. I'm not exactly sure what you mean here. I mean, I'm not going to put so typically when you sell a calendar spread, if you're selling the front month, the closest month to you, so let's say it's June 1st and I sell a June 30th call and I buy a July 28th call, I'm not going to collect as much money as I had to pay because there's less time premium in there. But I do expect that I'm going to sell multiple times, at least 2 times, against that long call, and I should more than make it up for it. Now, typically, anytime you're selling, you're hoping that the vol is high in the short month and lower in the long month, and vols will continue to rise once you get out of that first one. But once you have that long call in place, you have options because it doesn't matter what the market does. I might not be able to sell that much and make that much from it if the market tanks. Whatever, I took it. But if the market goes up, I'll be able to make more money back.
And you'll have positions on the other side for that. It's all about playing the odds, really, isn't it? But it's worth also remembering that you shouldn't consider each position as its own discrete thing that's got to make money. Sometimes you're happy to have one position that's gradually losing money while other positions are making money faster, and you just have that long position on to protect you against sort of any adverse market movements that you can't hedge while you're in bed or sleeping.
Yeah. And that's another good point about, let's say the market goes up 30% tomorrow for some crazy news. Well, those puts, 3, 4, 5, 6, 8 months out are going to get a lot cheaper real quick. Good time to buy them. Just don't spend too much money, but buy a bunch of really cheap puts because there's a good chance the market might start to come in. Not saying those puts are ever going to be in the money, but we can use those puts and sell puts against them on any moves down and make them pay for themselves plus. So it just gives us options. You could always hedge those right away too. You could buy those puts and hedge them and just sit there and wait. let those be.
I know people who spend like 10% of their profits on buying far out of the money puts or low delta puts, which actually brings us to the next question. Are you guys using delta as a proxy for probabilities being in the money? Shane might say that. I wouldn't. I use delta just because it's when you do this a lot, you stop caring about the actual dollar values of the strikes, and all you care about is the deltas, and the deltas you read off the vol surface, because you get if you're delta neutral, like I tend to be, you tend to care about selling options at the highest possible vol and buying them at the lowest possible vol. So what I do is I look on the vol surface to find out at what delta is the highest vol, and then I'll just buy or sell that delta, and that just happens to be at some strike, which I kind of ignore. When you're kind of trading classic retail, where you tend not to delta hedge that often, you do care about strikes because you care about how far from the money you are. So you think in terms of dollars of moneyness as opposed to delta. But for me, who delta hedges, well, depending on the book I'm trading, it's either every 5 minutes or 2 minutes or hour or day. Delta is kind of a more appropriate thing to measure, to care about. That's all.
Okay. And Manver, you asked a question about where to see the courses we have in the Academy. I just sent you a link. Next question here from KDC. When we're talking about long or short spreads, do we always refer to the near leg, i.e. a short call spread, short the near strike, long the further strike, and long call spread, long is the near tenor, and short the further tenor. So if it's short, if it's a short spread, it means you're making that's the closest strike. Yeah. If it's a long spread, that's you're buying the closest strike.
You've got to be careful here. Different markets have different conventions. If you go onto like Interactive Brokers, you'll see that they talk in terms of bull call spreads and bear call spreads. I just talk in terms of call spreads. And as far as I'm concerned, yes, you talk about the spread as if you're always buying it. So you think about buy the close to the money, sell the far from the money. Mm-hmm. And if you're going to sell that spread, you just reverse the two.
Yeah, and if someone says, "Hey, I'm short this strategy, I'm short whatever strategy happens to be," it means they made money. It means they collected some premium. And remember, whenever we're selling, we're limiting our profit to whatever we collect. And we can adjust that later on, but that's the initial strategy. That's what we're doing. If wherever we're buying, we typically it doesn't mean you have unlimited profit, of course, because it can be a spread, but you're paying some money up front. Question from Mia: are you still short those puts? I don't have any short puts. Maybe Richard is. Do you have short puts?
Yeah, I've got a load of degenerate short puts on my ETH book. Well, a load of them expired today, actually.
Okay.
But I still got a bunch of short puts through the next 3 weeks of June. But I'm delta hedging very often on that book. I'm just picking up. I think I'm just picking up. About $45 a day in theta on that. It's a $20,000 book. So it's gone from being a hugely degenerate book that was paying me $150 a day with 70% margin use to a fairly sedate book paying me $45 a day with 38% maintenance margin. And I'm short more calls than I am puts, to be honest, because I'm always a bit wary of selling puts, particularly when vol's been low for a long time. And, the Bitcoin markets, by which I include ETH, do tend to have a horrible sell-off every 100 days. And we've been, we're getting well over that now. It's kind of like that big national park in America full of volcanoes.
The super volcano, Yellowstone.
It's kind of that's apparently overdue as well. It goes off every 600,000 years, and so I'm kind of wary of being too short puts at the moment. But that's where the money is, because that's where the skew's on the downside. But the professionals are all telling me that they're buying downside at the moment.
Okay, and there's a follow-up question that it says, how do you protect those yourself? But you're saying you're hedging all the time, so.
I've got on that book, I'm running a automatic delta hedger, which is looking at the market every 5 minutes, and if the delta gets bigger than a certain threshold, it sells or buys perpetuals. But if I was trading that retail without mechanical help, then I would sell put spreads, and I'd be accepting that I might suddenly go blasting through those at some stage, and I might find myself having a day of frantic hedging with futures while it all calms down.
Yeah. We're getting lean on time here. So let's see. A question from Gene. How to choose what to roll when having multiple positions and looking at your overall portfolio? That's a really good question, because it's easy to start to just, you do one strategy and you get another one on, and you start to lose track of, hang on, was this a spread, or what was this from? And you lose track, and you probably end up are better off looking at it from a portfolio view versus an individual strategy view. And one thing I will say about that is, when things get so complicated, I need to go in there and I need to clean that book out, because you don't know what's going on. You're not sure. Hang on, if the market goes up, you got to look at your overall delta, and you're trying to figure out old positions. It's just gets very, very confusing very quickly. But what's your suggestion there for managing that on a portfolio level?
Well, I never really care about individual positions. I care more about the risk of the entire book, and so does Deribit, so does their margin system. So I tend to, if a position's got like more than 25 days to run, and it's at the money at the result of a strong rally, and I think the market could sell off again before it drives on up again, right? So maybe I'll wait, because I'll let some of that time premium come out. Maybe just sell a put against that call and take in some more premium to give myself some more time. I'm talking about hedging without futures, as Ekrem is asking, right? But if it starts to get close to expiry, like certainly within 2 weeks, I definitely don't want to be sitting on a 50 delta option short position. It's got a massive gamma. It's relatively good time decay, but that's not going to outweigh the gamma risk I'm running, particularly in a crypto market. So I'm definitely going to want to roll that away out to a month or 2 months even, depending on how scared I am. But I would just take it on a strike by strike basis. Just look at the ones that are getting close to the money and just deal with those, and then leave the rest for time decay to do its work. That's probably how I'd do it.
Yeah. Another question here, Ekrem. When you are short straddle, 80 days out, the price tends to hit 0.01 delta very frequently. Taking into account not being a good future trader, how do you manage such a position? It seems that future hedging will most probably eat your profits away until expiry.
So that depends on how often you hedge with futures and how well you do it. If you just, let's say you're short, I don't know, 1 Bitcoin of call spread, and you've got a delta of, I don't know, well, minus 0.2 Bitcoins, and the market starts to gain momentum going up, then you might want to just buy 0.05 Bitcoins of futures, right? You don't want to get too aggressive, and you might just want to leave it there. And you could just leave that futures position in, regardless of what the market does, and regardless of whether that short call eventually ends up in the money or not. Because if it does end up in the money, then that future is going to give you more firepower to roll to a higher strike, because you've already got P&L in the future. And if the future isn't making money, well, you took in premium for your short call. You can always sell another one. So it then becomes kind of no different to just selling covered calls, or even
synthetic covered call.
Right. So there's no need to sort of sit and day trade that future. You're just sort of putting it in there to undermine the trend of the market.
Yeah.
Having said that, I do trade futures often. I think in the past 24 hours, I think we traded about 50 times as the market bounced up and down. We burned a bit of money, but we made more money in vol decay and time decay and vol decay, so we don't really mind. It's a game of trade-offs, right? You give, as long as you give less than you get, then you're winning.
All right, next question from KDC. Do you guys trade dailies? If yes, for what situations? If no, why do others trade them? What cases do you see? So,
because they're nuts.
so I was just going to say yes, sometimes I do. So here's the thing. If you're trading the dailies, you've got to be sitting in front of your computer trading. Now, this is gamma trading, right? So if I'm trading something that's expiring today or tomorrow or even this week, we've got a really high gamma. And that's what, if you're sitting there, if you're a technical analyst and you think, hey, the price is coming down, your triggers, your alarms are going off, and you think it's going to cross your technicals or have a bounce or bust through or whatever you think you might be happening, that's when you want to pound in. I'm typically buying an at the money option. We're close to at the money, looking for that quick gain, price movement, and selling it. That's when you can do 1,000% on a day on that trade, or 200%, or you start to pull in those big numbers. But that's a completely different game, and you got to be sitting in front of the computer. I do plan to have a course because that's what I did for a long time. I haven't really done that a lot in the last 7 or 8 years, but I would like to run a course on that in the near future, because it's a lot of fun when you've got a bit of time to do it. I love doing it, but I just don't have time to do it all the time.
And I tend not to trade dailies except for a few cases, and one would be coming up. We've got the Fed's announcement coming up on Tuesday, right? So you can be sure that the vol on the expiry of that Tuesday is going to be higher than the day after. So what I might do, given that I've got a computer here sitting in auto delta hedging for me, I might sell the overnights for the FOMC day, and then buy the options for the day after, something like that. Right. Because the overnights will be trading at more like 80 volt, and the day after will be more like 40 volt. So I could pick up that vol decay.
Okay, one last question. We've got to go. We've run over time, but that's okay. I think we always want to make sure we try and get all the questions answered. Sylvanius asks, can you totally hedge a short call with futures?
If you hedge constantly, yes, you can mimic the payoff of a short call with futures. However, you are going to pay spreads and trading fees every time you hedge. So you're going to follow the options price action, but you're going to lose something in the trading. So there's a trade-off between the more often you hedge, the more you're going to pay, but the less frequently you hedge, the less accurately you're going to model that options payoff. And what I can tell you from certainty, having done a lot of experimentation with this, is if you keep your position size low on each strike, you split your positions across multiple strikes, and you leg into your positions on a day-by-day basis rather than all at once, then actually hedging daily is generally enough to mitigate the risk of going through your strikes. And if you can get slightly better performance by hedging hourly or even less, but the difference isn't so big, right? So actually, even if you're retail, hedging systematically daily is a wise thing to do.
Yeah, like dollar cost averaging. There you go. Hey, that's it. Let's wrap it up today. Thanks everyone for joining us. It was again, interesting topic. Rolling is something that every options trader has to do at some point or another, so it's great we can talk about it. So next week we're going to talk about covered calls, I think, which is interesting because covered calls are the most common option strategy out there, but there's some things you need to know, and there's some common pitfalls that make them maybe not always the best choice. So we're going to talk about covered calls, synthetic covered calls, and some other good stuff around that. So join us next week for the next Deribit Live, and for us over here at Rogue Trader Academy. Thanks for joining us.